Good afternoon and welcome to Money Matters TV. I'm your host, Jeff Watkinson. I'm very excited about today's show. First, I'd like to introduce my co-host, Steve Rosenberg, who is principal at the GSD Group. And I'm going to give you a little background on Steve. He's helped manage and produce events for the National Hockey League, the Neutral Site, the World Wrestling, WWE, and the Ringling Brothers, Barnum and Bailey Circus, just to name a few. It seems to me, after reading Steve's bio, that if the Olympics were ever in Philadelphia and there was a problem, we would be calling Steve Rosenberg to help solve this problem as a master networker. Welcome aboard, Steve.
Jeff, thank you. That's a really nice introduction. Nice to be here with you today. And I hope they would call, but you never know. Let's hope we get the Olympics. Let's hope we have that problem.
Let's hope we have that problem as well. If there's a problem, we'll attack it. You line it up, we'll knock it down.
Exactly.
Steve, welcome aboard. Steve's got a big background in sports. He started off his career with the Washington Bullets. And we were thinking about, topics to discuss, and sports collectibles came up. And, I'm on the municipal bond side. Bonds, along with stocks and cash, are considered traditional asset classes, and collectibles such as artwork, sports memorabilia, collectibles, racing cars, stamps, they all can be considered an alternative asset class. And Steve and I quickly figured out that collectibles would be a great topic to discuss for Money Matters TV. Steve, what are you seeing right now in collectibles in 2023?
Jeff, it's mind-numbing. Every day, every single day, the numbers get bigger and bigger. If I told you as a money guy that the compound annual growth rate of the NFT industry was 33.7%, that's a big number. It's hard to imagine, right? In 2021, there was about $11 billion in NFT trading. By 2030, it's going to be close to $232 billion. And we haven't even begun to scratch the surface. I believe, and I'm no genius here, okay? But, COVID really brought people mind back to collectibles, right? They were sitting at home. They didn't know what to do. They found their old baseball cards, or they went to a storage unit, foreshadowing there, and they got some trading cards out, and they saw that they were worth some money, or they found old jerseys. Well, now these non-fungible tokens, NFT, on the blockchain have the values are incredible, and soon they may be a traditional asset class. And what I think you're going to start to see is not just collectibles of a LeBron James highlight that you keep up on the blockchain, but I actually think you're going to start to see things like, imagine you buy a Bryce Harper jersey, and embedded in the jersey is a QR code, right? So that actually gets you into the stadium. No more tickets, no more anything. But then also within that, if Bryce hits a home run, the home run highlight automatically gets downloaded to your jersey, which then you take home and you upload to your own blockchain. That's where I think we're going with all of this, which is way too fast for my old brain to figure out, because I still like to have, physical assets. It's a quick aside. I went to the Phillies game last night, and I was probably one of 40,000 people that walked in with a ticket, an actual ticket. But someone gave it to me. But so these NFTs are growing.
You still walked in with a physical ticket.
Physical ticket. Like that, people looked at me like I had like I was a unicorn. But the NFTs are pacing with sports gambling, and the two are, I don't want to say tied together, but the numbers, Jeff, are mind-numbing. And people like you, because you have you're advising people are spending a lot of money on these things, a lot.
Absolutely. I mean, we all know like the Honus Wagner baseball card from 120 years ago, the Mickey Mantle rookie card. I mean, I got into baseball cards in the late 90s, late 80s, early 90s. It went, the market crashed. I mean, it was my first crash, I think in 92 or 93 with sports collectibles. And I still have essentially worthless sets of Topps baseball cards in my closet.
They're not worthless anymore. I'm telling you, I have a dear relative of mine who is sitting on about 500,000 cards in really good shape. And he's trying to figure out now what to do with them, how to get them valued, what the best and quickest way to do it is. And there are people that may offer him 5 cents for each card, because within those cards, there's some cards that are going to be worth a lot of money, and there's some cards that are going to be worthless. And you have collectors like that are just trying to figure out what to do. I was at the Atlantic City Card Show last summer. I figured there'd be a few thousand people there. The lines to get in the door were crazy. And these were still for physical assets.
Excuse me, the Atlantic City Card Show, or
the Atlantic City Card, like the baseball card.
Okay, baseball cards, yeah.
And this year it's going to be even larger, because there's going to be an entire section built around these NFTs. I don't know how you show them or how you display them, right? But it's growing at a rate that if we don't keep our eye on it, like 33% compound annual growth rate is very large, and I would suspect it's only going to get bigger.
Yeah, that's a very strong growth rate, 33%.
I take it.
Absolutely. I find it fascinating. I mean, there's crypto, there's blockchain, there's athletics, there's QR codes, there's phone, there's interactive. I think it was the Super Bowl 2 years ago where you could QR code on the screen. I find it moving extremely fast.
Very fast, very fast. So we'll see what happens. But it's a great question. So thanks for asking it.
Yeah, I mean, we have a very special guest today. He's involved with storage, and that's kind of how we came up with this idea of finding lost treasure. The show Storage Wars. What's this stuff worth? I for one, where would you suggest if you find something? Do you have any ideas? I mean, I have a couple.
There's a couple companies out there, but it's you have to really find the right person, because like anything else, you will get swindled if you go to the wrong person, because there are experts in everything. But there's some good people out there, and maybe that would be somebody that would be a good guest for Money Matters down the line, because that would take us off into a whole different tangent. But there's really good local card collectors in almost every town that are good, honest brokers. That's where I would start. But stay away from some of these apps that value your cards and everything else, because
Facebook Marketplace, it's kind of the wild west.
Yeah.
Okay, great. Well, it's time to ask the question of the week. Robin Martin from Philadelphia, PA. How is sports signage developed, and is it expensive?
Well, Robin, that's a great question. And so signage, like any other signage, is expensive, but sports signage is typically sold as part of a package, usually tied to media. In today's world, mostly TV. So if you go down to the Wells Fargo Center or to Citizens Bank Park and you see signs all over the place, what's happening is whoever the advertiser is buying a package from the Phillies or the Sixers or the Flyers. And within that, whether it's around the hockey boards, which are called dasher boards, or their backlit signs, or their big monument signs, the team or the arena or the management company is paying for that as part of an overall package. Dasher boards are just stickers. And then you have backlit signage where you're paying for a box and then a translucent sign, right? So all signage is expensive, and all signage is expensive depending on the type of signage it is. But the advertisers typically don't pay for those signs. It's the team or the property where you're buying the sponsorship that actually bears those costs.
Okay, thank you. Here's how to send in your questions to Money Matters TV.
You can have your questions answered on Money Matters. Please go to our website, money-matterstv.com. On our homepage, click on the banner on the right that says, Send us your questions. While you're on our website, you can find information about our host and guests, as well as show notes and links about this show and past shows. Money Matters is also available as a podcast on iTunes and Stitcher, so you can listen to Money Matters while you're on the go. That website address, again, is money, MONEY, -matters, MATTERS, TV.com.
Thank you, and welcome back to Money Matters. I'm very excited to introduce our next guest. I used to caddy for the father of our next guest, Tom Dunkel, when I was 12, 13 years old. I've been seeing Tom on LinkedIn. He's been posting a lot about his business, Belrose Storage Group. And I've been wanting to catch up with him. I hadn't spoken to him for years. And then I found out that he was going to be a guest on the show. I'm so happy to welcome Tom Dunkel, CIO of the Belrose Storage Group. Welcome to Money Matters TV.
Hey, Jeff, my friend. Great to reconnect with you. And hello, Steve. Nice to meet you.
You too, Tom.
Terrific, Tom. Tom, tell us about Belrose Storage Group. What's your business plan? What you're working on? I'm very fascinated about the self-storage industry as a whole.
Sure. And the quick highlights about self-storage are, it's becoming more and more adopted by households that are stretched to the gills, buying too much stuff. It just seems to be an American obsession. We're specifically looking at markets, Jeff, in the Southeast, where I know here in Philly, right? We can store our stuff in the attic. A lot of us have basements. But you start getting down south, there's no attics and there's no basements. But those folks still need a place to store their extra goodies. So they choose self-storage. And a few years back, there might have been about 8% of households in the country were using self-storage. But these days it's over 11 going on 12%. I know that might not sound like a big jump, 3-4 percentage points. But when you consider there's over 120 million households in the country, every 1% move it means 1.2 million new self-storage customers. And there's only about 55,000 self-storage facilities across the country. So demand is strong. So we're enjoying that.
Hey, Tom, I had said to Jeff when we were talking earlier that it seems like it's not just families that are interested. It seems like real estate investors and developers are seeing that there's only these 55,000, because it seems like everybody that I talk to is talking about buying, building, purchasing, whatever, storage units, because there is just not enough. And it seems like the return from a business perspective is actually quite good because there is this real demand. Are you seeing that as well?
100%, Steve. Yeah, that's exactly what was a big draw for our company to the self-storage industry, because we haven't always been in self-storage. My partner, Joe Downs, and I connected after the Great Recession. We were both looking for a way to kind of reinvent and rebuild back then. And we've had some successful businesses along the way in different asset classes. But a lot of other asset classes are very, very volatile, very up and down, very unpredictable. But one of the things we love about storage is if you look back over the past 40 years, when the U.S. economy has been going up and down, we've had good times and bad times and in between times and really good times and really bad times. Throughout that whole time period, self-storage occupancy rates around the country have kind of gently meandered between like 80 and 90%. And the reason is, when times are good, right? People are buying things, they're buying the new bike, the motorcycle, and they're putting it in storage because they don't have room at home. When times are bad, divorces, death, downturns, downsizings, all those kinds of things that force a transition in a person's life, that can be a trigger for them needing self-storage. And so that's why it tends to stay buoyant in even tough times.
That's very interesting. In other words, are you saying this is a very steady cash flow asset class that's recession proof?
I wouldn't go as far, Jeff, as to call it recession proof, because we're certainly susceptible to some ups and downs here and there, but certainly recession resistant. And for where we are in the economy right now, I think it's a really important thing for investors to be looking for is that place to preserve capital. It's, in my opinion, it's not a time right now to be, really swinging for the fences. I think now is a really good time for investors to be putting their hard-earned money into hard assets that have cash flow associated with them and some growth potential. But certainly that capital preservation for me as an investor is first and foremost where we are in the cycle.
Hey, Tom, Jeff mentioned early in the show, and he and I were talking, the show Storage Wars on A&E debuted in 2011, and I feel like that opened a lot of people's eyes to storage units. Have you seen any anecdotal growth to your business from that show, that people said, oh, look at these storage, not just from I want to go and find hidden treasures, but from oh my God, I never even thought about the fact that there are storage units. Has there been any sort of, from that show, and any growth, or is it just sort of coincidental?
I'm not sure if there's a correlation there, Steve. I think that show is kind of a made-for-TV kind of show. It's not really very representative of how we handle delinquencies at our self-storage facilities. These days, of course, everything's done online, right? So when we have a tenant that hasn't paid for 60 days, they get a notice, and then their goods, some pictures are taken, and those pictures are thrown up on a auction site. And click, click, click. People can look at those delinquent facilities, those delinquent units, and they can bid on those products that they're seeing in there from the pictures. And so then the beautiful thing for us, right, is it's very hands off. We take a few pictures, post the pictures. The auction ends, the winner is determined, and that person has 72 hours to get physically to the facility and clear out the unit, which of course is a great service to us, because one of the beautiful things about self-storage, unlike some other renting houses or apartments, is we can turn our units over very, very quickly. So as soon as that auction is over and that person who won the auction cleans out their stuff, we just simply go in with a broom, sweep things up, maybe grease the door a little bit, and then it's back up on our website to be rented once again.
Tom, I got a question for you. And I want to go back to like a 30,000 foot view of the market. I mean, I drive around Chester County, Pennsylvania, and I see Cube Smart, Public Storage, Extra Space Storage. I mean, they look like beautiful facilities. I mean, how big are they in the marketplace? I mean, tell me about the landscape of the public storage.
Sure. Yeah, that's a great question, Jeff. And again, it's one of the things that we really like about self-storage is that it is a very highly fragmented industry. And what I mean by that is that, the big names that you mentioned, Jeff, those are the big REITs, the real estate investment trusts, and they're publicly traded out there. You can go and buy them in your, whatever account. But those are the big guys. The interesting thing, though, is that most people don't realize those big companies only control about 30 or 35% of the self-storage market. The other, call it 70%, is largely moms and pops. These are onesie, twosie facility owners. They don't really run it like a business. It's really just kind of a side thing for them. So what they end up doing is they keep their rents artificially low because they want their units filled. Because the last thing they want to do is have to deal with putting up a website or running a marketing plan or using technology and search engine optimization and all those things that we use as a professional management company to generate business. So it gives us a great opportunity as an investor to go in and acquire an underperforming facility and put our proven value add strategies in place to increase the value, which generates a great return for our investors.
Do they manage them? Are there management companies that play the role of a middle person for like the Cube Smarts and the big REITs? Do you manage other people's properties, or do you strictly stay in your owned and operated facilities?
Yeah, great question. We manage our own facilities, and we use what we call a hybrid management strategy. And what we mean by that is we have a warm body, a physical person who's assigned to each facility that we own, but they're only physically at the facility a handful of days per month. The rest of the time, they're handling customer issues and renting units, et cetera, remotely, because, of course, the beautiful thing about technology is we can run these facilities remotely. In fact, a lot of the managers of the facilities can run them from their smartphones. So the facility phone number will ring to their cell phone. They can pull up the storage management app on their phone and look up the customer and say, "Oh yeah, Mr. Customer, you owe $120," and so they can take the payment right there over the phone and all of that. So we don't need to physically have a person on site. And the beautiful thing about that as a business means we're not paying for a full-time body at that facility, which allows us to lower our expenses and increase our profit.
Tom, I got a question for you. You got investing in like a multifamily project or unit compared to investing in a public storage facility like what you're offering. What are some of the similarities and differences when evaluating these two different types of real estate investing?
Sure. Yeah, I actually have been investing in apartments myself since 2013, so I know that asset class pretty well. And there are a lot of similarities, Jeff, between apartment investing or multifamily, as they call it, and investing in a self-storage facility. Namely, those are kind of the market drivers, right? We want to see a very healthy market with a steady, if not increasing population. We like to see job growth, and we like to see infrastructure investments being made in that area, right? So highways being widened, roads being widened, schools being built, all those kinds of things. Because all of those things point to more people and more demand, whether it's for apartments or self-storage. So there's definitely similarities in that regard. Where things get a little different is, and I touched on it a little bit earlier, is the operations of the facility versus the multifamily property. At a multifamily property, for an example, if $100 of rent comes in, after paying property taxes, insurance, utilities, repairs and maintenance, and payroll, etc., those operating expenses, there's only about 30 or 35 bucks left over. Self-storage is the exact opposite. And what I mean by that is when $100 of rent comes into a self-storage facility, we have taxes, we have insurance, we have maintenance, we have utilities, we have those same expenses. But once we take all those out, we have like 70 bucks left over. So that gives us a lot of cash flow left to pay our debt and also pay our investors. So that's a big difference.
Are municipalities welcoming to storage facilities? I mean, they want multifamily because that brings people and people spend money and then supermarkets get built. But what's sort of the zoning, or are there zoning restrictions when it comes to storage units?
Yeah, that's a great question, Steve. It's believe it or not, it's actually becomes a bit of a competitive advantage if we are able to acquire a facility in a market where the municipality is not allowing any more self-storage development, right? So we kind of have a captured audience, because you're right. Self-storage facilities, they don't generate a lot of tax revenue for the local municipalities because there's not a lot of people there. And so the municipality doesn't necessarily benefit very much. And actually, we ran into that up in Horsham Township. We were looking at doing a deal up there a while back, and we needed to get a zoning variance from Horsham Township. And we did a lot of work up front and to get things ready to go. And then when we met with Horsham Township, they were like, nope, doesn't generate enough taxes for us. So we're not going to allow you to do that project. So,
Tom, I got a question for you. How would somebody invest? I mean, how do you raise money? How would somebody invest with you, with Belrose? Mm-hmm. And how would that process? I mean, you can't predict the future, but what kind of experience would someone expect?
Sure. Yeah. So you'll see over my shoulder here, we have our company purpose and our core values and that sort of thing. And one of them, Jeff, is that we're really in this business to help people build wealth. I'm an investor myself. My partners were investors. And the way we started out, right, was, friends and family, friends we knew from hanging out, playing golf, going to school, whatever we were doing. And so this is very personal for us. And so we are out there looking for the best deals we can find, because we're putting up not only our own money, but friends, close family, et cetera. So the way the process works, Jeff, is we put out a private placement memorandum. This is all buttoned up legally with a Securities and Exchange Commission experienced attorney that's experienced in securities law. We use Armstrong Teasdale out of Philadelphia. Jason Mandel, fantastic attorney. And what's funny is he's like a rock star attorney, and he works on these $100 million big, very complex commercial deals. But the reason he's working with us at Belrose is, guys, I used to play tennis with him.
Okay.
He's like a Ferrari for our smaller kind of homegrown deals. But yeah, so Jason and his team get involved. All the documentation is super tight. And basically we just go out to our friends and family, say, hey, here's the property. The mom and pop owners their rents are currently 30% under market, and they're running all kinds of expenses through the business. They're overpaying their nephew to run the facility. I mean, these are all things that we've run into for real. And so we come up with a plan with our expert operations team to say, hey, we're going to be able to raise rents this much. We're going to be able to manage the expenses to this level. And if we project that out over a few years, we're going to be able to generate a nice return for our investors after exiting the property, selling it, paying off the debt. There's going to be plenty of money left over to pay back the initial investment, plus a nice profit split, so everyone can enjoy a nice return. But it's all very well documented, and it's all run electronically. Of course, back to technology, we have an investor portal where folks can sign up in our investor portal, and that's where we announce our offerings, and that's where the documents live, and everything kind of happens electronically through there.
In 30 seconds, can you say, do you ever look at units that have air rights, or are you more of a traditional campus, I guess you might call it? Because I see so many, particularly in the cities, where units are being built on top of each other because there's no land.
Yeah, Steve, we haven't run into that. We're mostly in secondary and tertiary markets where we're single story or maybe 2-story kind of buildings. I mean, the most we'll do there is maybe a billboard or a cell phone tower or those kinds of things, but we don't get too extravagant with the air rights and that kind of thing.
Got it. Thank you.
Mm-hmm.
I'm going to ask one final 30-second question as well. What's the future look like for Belrose Storage?
Yeah, Jeff, I mean, we're really excited about where we're at right now. I mean, self-storage has been a great industry for us, but it's evolving. Kind of like you guys were talking before I got on about, QR codes and digitizing self-storage. All those things are happening in our industry as well. Some of the nearer term exciting things for us are expanding into boat and RV storage. A lot of homeowners associations will not allow people to park their boat or RV on site, so they got to park it somewhere else. So may as well park it with us.
Tom, thank you so much for coming on the program today. I want to thank my co-host, Steve. That was a lot of fun. And I want to announce our next guest, who is Vladimir Valko, CEO of Tile Health Incorporated.